AI infrastructure offerings from leading labs such as Ineffable Intelligence, next-generation AI builders, including Kakao, financial services like Deutsche Börse Group, pharmaceutical companies such as Pfizer and Roche, and robotics and spatial intelligence companies such as World Labs. We are continuing our strategy of investing in promising companies and internal efforts that bring pioneering AI research into the real world. We have seen exciting progress from our other bets. Waymo introduced its newest vehicle for high-to-public riders. This is the first vehicle powered by the sixth-generation Waymo driver and will welcome more riders in the coming months. Wing has safely completed more than 1 million home deliveries, and we continue to grow our presence through partnerships with Walmart, DoorDash, and Papa John's. In health and drug discovery, Isomorphic Labs raised over $2 billion to power its AI drug design engine, scale globally, and advance its drug candidate pipeline. It's truly been an extraordinary first half of 2026, with much more to come. Thanks to all of our employees and partners worldwide for their incredible work this quarter. With that, Philip, over to you.
Thanks, Sundar, and hello, everyone. I'll start with a review of Google Services, highlighting our momentum across search, YouTube, and partnerships. Google Services revenues were $95 billion for the quarter, up 15% year-on-year, primarily driven by search. Search and other delivered 17% growth, with retail and finance driving the largest contribution.
About being a human being.
Sundar Pichai, welcome back to Hard Fork.
Thanks for having me. Great to be here.
So the last time we
I think, obviously, getting it out in the real world and
starting with search and other. Revenues reached over $63 billion for the quarter. Sundar highlighted the momentum we see in search, which directly impacts our advertising business. We continue to accelerate the deployment of Gemini across our entire ads infrastructure to boost performance in three areas mentioned before: ads quality, advertiser tools, and AI user experiences. First, ads quality. At Google Marketing Live, we showcased how Gemini improves query understanding, allowing us to find relevant ads for longer searches previously difficult to monetize. The core engine of our search ads relies on a dual prediction, delivering immediate utility for the user while maximizing measurable value for the advertiser. Gemini completely supercharges this capability. We use Gemini's advanced reasoning to decode the nuances of longer, more detailed queries. With shopping ads, for instance, we drove a 20% improvement in showing highly relevant ads, helping shoppers immediately find the best match. Second, advertiser tools. Take AI Max. It has become the core building block for advertisers to fully participate in our new AI experiences. It's out of beta, and 500,000 advertisers have already adopted it. Those who adopt our AI-powered campaigns like AI Max or PMax see an average of 15% more conversions or value on search at a similar ROAS. AAA Auto Club enterprises used AI Max to personalize creative assets and capture growth from increasingly detailed insurance searches. This led to a 17% improvement in conversion volume and an 11% decrease in cost per lead. We see strong adoption of our generative AI creative tools, which makes creative development easier, especially for SMBs. In fact, over half of our SMB customers globally use AI to create or optimize their creatives. Third, new AI user experiences. At I/O, we showed how search, including AI overviews and AI mode, works as one connected experience. As you saw from our results, our performance across this holistic system is robust. We continue to be encouraged with monetization performance on queries that show AI overviews, even as we've expanded AI overviews to more commercial queries. Across AI overviews and AI mode, people are asking more specific and detailed questions, providing opportunities for more relevant ads. Within AI mode, we continue to test and deploy a range of new ad formats. For text ads, we improved performance by adding contextual site links based on the conversation. Direct offers is gaining momentum, with partners like IHG Hotels and Resorts soon surfacing special offers during trip planning. In highlighted answers, our latest experience, placing clearly marked sponsored links inside list responses, is showing early user traction. Looking at commerce, In collaboration with the retail industry, we established the Open Source Universal Commerce Protocol, UCP, as the new standard for agentic commerce. Merchants are rapidly adopting UCP, with Target and Steve Madden now live, while new members have joined the UCP Shopping and Food Tech Councils to help steer its vision. We also announced Universal Cart, allowing shoppers to add items from different retailers across Google services and buy in a single checkout. Now onto YouTube. As a FIFA preferred platform partner, we help fans around the world tune into the games. As Sundar mentioned, over 1.7 billion unique viewers watched World Cup related videos, and over 550 million watched them on their televisions. This made the FIFA World Cup 2026 the most viewed World Cup in YouTube history. Advertisers connected with fans through FIFA channel takeovers, Gemini-powered soccer-themed sponsorships, and game day mastheads. And, of course, a huge congratulations to Spain for taking home the trophy. More broadly, on YouTube, we introduced an exclusive slate of creator shows, making it easier for brands to tap into the fandom of creators. We launched custom sponsorships to put brands at the heart of the world's biggest moments as they unfold on YouTube, using AI to dynamically surface videos tailored to a brand's desired moment. Brands continue to partner with YouTube creators to engage new audiences. Kate Spade reached Gen Z through a first-of-its-kind YouTube creator campaign and partnered with creators Ellie Thuman and Hannah Meloche. By leveraging multiple format videos on YouTube, the brand drove a 3.25% brand lift in purchase intent. This unique convergence of brand equity and commercial action makes YouTube a powerful full-funnel platform. SMBs continue to fuel our direct response growth through campaigns like Demand Gen. They leverage our AI to scale visual storytelling across YouTube, Shorts, and now Google Maps. To attract high-value shoppers across North America and Europe, outdoor brand Arc'teryx used Demand Gen to achieve a 70% better return on their ad spend compared to other paid channels. Looking at monetization across YouTube, we're driving sustained growth across our key priorities. In the living room, we see continued momentum across both brand and direct response. With the launch of Buy with Google Pay, viewers can complete purchases directly on their CTV, turning the TV screen into a stronger performance surface. Shorts continues to deliver high-performing opportunities for social and video buyers alike. Beyond advertising, YouTube subscription business, which thrives across living room screens, is growing faster than ads, particularly driven by YouTube Music and Premium. Internally, we leverage Gemini to transform how we work and how we serve our customers. 83% of our sales team uses Gemini-assisted tools weekly, driving up to a 20% higher win rate when using customized pitch narratives. Our ads customer support teams use Gemini-powered agentic solutions that now autonomously address 75% of support queries, freeing them to solve our customers' most complex challenges. Similarly, our new agentic solutions for SMBs have expanded our reach by hundreds of thousands of new customers year to date. As always, ending with partnerships. We're seeing more businesses benefit from the unified strength of Google's AI stack. Booking Holdings expanded a multi-year cloud commitment and are partnering closely to advance our AI-powered ad formats. It's also deploying Google's AI technology to enable new customer experiences like agentic dining reservations on OpenTable, helping restaurants get discovered and booked right when it matters most. In closing, I'd like to thank Googlers everywhere for their contributions to our success and our customers and partners for their continued trust. Anat, over to you.
Thank you, Philip. My comments will focus on year-over-year comparisons for the second quarter, unless I state otherwise. I will start with results at the Alphabet level and will then cover our segment's result. I'll end with some commentary on our outlook for the third quarter and full year 2026. We had an outstanding second quarter, delivering our 12th consecutive quarter of double-digit revenue growth. Consolidated revenues were $119.8 billion, up 24% or 23% in constant currency. Total cost of revenues was $45.9 billion, up 18%. Tech was $16.2 billion, up 10%. Other cost of revenues was $29.8 billion, up 22%, driven by increases in depreciation, inventory costs, primarily from the sales of TPU systems to customers, and content acquisition costs, largely for YouTube. Total operating expenses were up 27% to $33.1 billion. R&D expenses increased by 32%, driven by compensation from investments in AI talent as well as depreciation. Sales and marketing expenses were up 18% due to investments to support the Gemini app and search and compensation. And G&A expenses increased 24%, primarily driven by compensation and charges for certain legal and other matters. Operating income increased 30% to $40.8 billion, and operating margin was 34%. Other income and expenses was $98 billion, representing a substantial increase from the prior year, primarily due to unrealized gains in our equities securities portfolio. Net income and earnings per share increased significantly, primarily due to the unrealized gains in OI&E I just mentioned. We generated strong operating cash flow of $39.1 billion in the second quarter and $185.7 billion for the trailing 12 months. CapEx was $44.9 billion in the second quarter, with the vast majority of the spend in technical infrastructure to support our investments in AI. Approximately 60% of our investment in technical infrastructure this quarter was in servers, and 40% was in data centers and networking equipment. We had negative free cash flow of $5.9 billion in the second quarter, driven by our investments in CapEx. Free cash flow was $53.3 billion for the trailing 12 months. We ended the quarter with $242.5 billion in cash and marketable securities, which includes $87.1 billion of marketable equity securities. Long-term debt was $98.2 billion. And as mentioned in our press release, our board of directors declared a quarterly cash dividend on our common stock of 22 cents per share, which is payable in September. Turning to segment results, Google Services revenues increased 15% to $94.5 billion, reflecting strong growth in search and subscriptions. Total advertising revenues were up 14%, with growth across all major verticals. We experienced strong ad growth related to the World Cup, particularly in YouTube ads. Google Search and other advertising revenues increased by 17% to $63.3 billion, with retail and finance driving the largest contributions. YouTube advertising revenues increased 13% to $11.1 billion, driven by direct response advertising, as well as brand, with strength in the living room, as Philip mentioned earlier. Network advertising revenues of $7.3 billion were down 1%. Subscription, platforms, and devices revenues increased 15% this quarter to $12.9 billion due to strong growth in both YouTube subscriptions, particularly YouTube Music and Premium, and Google One, which was driven by demand for AI plans. Google Services operating income increased 20% to $39.5 billion, and operating margin was 41.8%. The Google Cloud segment delivered outstanding results in the second quarter, driven by our enterprise AI products and services. Cloud revenues were up 82% to $24.8 billion, driven primarily by GCP, which grew faster than cloud overall. Core GCP, AI solutions, and AI infrastructure were all important drivers of growth. We also began to recognize revenues from TPU system sales, which we delivered to customer data centers for the first time in Q2. Cloud revenue growth accelerated meaningfully even after excluding the impact of TPU system sales. Cloud operating income was $8.8 billion, more than tripling year over year, and operating margin increased from 20.7% in the second quarter last year to 35.6%. Google Cloud's backlog increased by more than $50 billion sequentially, reaching $514 billion in the second quarter. The increase was driven by strong demand for our enterprise AI offerings. The majority of the backlog is related to typical GCP contracts from a broad mix of customers, and we expect to recognize just over 50% of the total backlog as revenue over the next 24 months. In other bets, revenues were $382 million, and operating loss was $1.8 billion as we continue to expand Waymo's business and invest in key other bets. And in Alphabet level activities, the operating loss was $5.8 billion, driven by shared AI R&D expenses. Turning to our outlook and business performance expectations in the second half of 2026. First, in terms of revenues, at the current spot rates, we would expect a slight FX headwind to our consolidated revenue in Q3 compared to a 1 percentage point FX tailwind in Q2. This impact will be seen primarily in search and YouTube ads. In Google Services, as Philip mentioned, we continue to benefit from innovation in search by improving the user and advertiser experience with AI. At the same time, in Q3, we will begin lapping an acceleration in search performance that began in the third quarter last year. In Google Cloud, we're seeing significant demand for products and services, which we expect to drive strong growth. As I mentioned earlier, we started delivering TPU system to customer data centers in the second quarter. We continue to expect to recognize a relatively small portion of the revenues from our existing TPU system sales agreements this year, ramping as we exit 2026. We anticipate the vast majority of the revenues from these agreements will be realized in 2027. And given the supply-constrained environment, we plan to expand the use of third-party capacity in Q3 as a bridging strategy while we build out more internal capacity. This strategy allows us to keep growing our customer base and capture greater overall value. However, it will create modest margin pressure in the near term as we utilize this capacity. Moving to investments, we are updating our full year 2026 CapEx guidance range to $195 to $205 billion, up from our previous estimate of $180 to $190 billion. The increase in the range is primarily due to an acceleration in the delivery of capacity to meet growing demand. As we previously shared, we continue to expect our CapEx to increase significantly in 2027, and will provide more details at a later date. In terms of expenses, the significant increase in our investments in technical infrastructure will continue to put pressure on the P&L in the form of higher depreciation expense and related data center operations costs such as energy. We also expect to continue hiring in key investment areas such as AI and cloud. And we are investing in marketing to support our AI products. And finally, we expect the free cash flow will remain under pressure, driven by our investments in technical infrastructure, which enables us to capitalize on the AI opportunity and continue to drive attractive returns. Q2 represented another strong quarter. Our teams continue to deliver impressive innovation, executing with discipline and velocity. I want to take this opportunity to thank our employees for their contribution to our performance. Sundar, Philip, and I will now take your questions.
Thank you. As a reminder, to ask a question, you will need to press *1 on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated. Our first question comes from Brian Nowak with Morgan Stanley. Your line is now open.
Thanks for taking my questions. I have two, one for Sundar, one for Anat. Sundar, with more time and Gen AI products and tools in the market and investment continuing to step up, can you just kind of give us some perspective on how your view on the size of the overall Gen AI ROIC opportunity and the timing of the ROIC has changed now versus 1 year ago? And then Anat, you talked quite a bit about supply capacity constraints. Maybe a similar question for you around forward CapEx. How is your budgeting philosophy and just constraints you're putting onto forward spend? How are those changing as you sort of think about the right amount to spend in 2027 to close this capacity constraint?
Look, thanks, Brian. I mean, it's a good question. I do think, it feels like we are in very early innings of what feels like secular shift across multiple areas. In our core information businesses, just the possibilities, when I see what all you can do with the absolute frontier capabilities, there's still a lot of work ahead to translate all that into experiences for our consumer users. You can think about end-to-end agentic experiences to really meaningfully do a lot more for them. So all of that looks like extraordinary opportunities with extraordinary returns for executing well on those opportunities. Similarly, on the enterprise side, as you can see from our uh, demand, which is reflected in our growth rates, etc. Again, in my conversations with many CEOs, many companies, uh, they're all still, barely scratching the early stages of what's possible here. So I think, we used to talk about cloud itself, very few, small percentage of overall workloads in enterprises have shifted to cloud. Now think about what percentage of workloads are really AI native and AI enabled. It again feels like very, very early. So I would say, from a ROIC standpoint, I think, we are taking a full stack approach. We are seeing momentum across consumers and enterprises and developers and so on. So it feels like, if anything, over the past year, we've gotten more bullish on the opportunities ahead. I'll turn it over to Anat.
Thanks for the question on how do we think about forward-looking CapEx in the context of um, supply constraints. So we're still in a supply constrained environment. I think we've said this now for multiple quarters in a row. And we are seeing very strong demand, both from external cloud customers as well as across the business. And our goal is to invest as long as we see an attractive return on that investment, as Sundar mentioned earlier. We do take a long-term view, so we take multi-year view at what the needs are, as well as focus on next year and the near term and building aggressively to meet those demands. And as you've seen, well, we have increased our capacity quite significantly over the past 3 years. The demand still outpaces that investment. And we are, just the rest of the industry, working in a supply constrained environment. So we're working hard to do this. We do have a benefit of having the full stack approach. So we're able to drive operational efficiencies, technological efficiencies within our technical infrastructure organization so that we can deliver more compute. But as long as we see these attractive opportunity to invest, we will continue to invest.
Thank you both.
Our next question comes from Doug Anmuth with JP Morgan. Your line is now open.
Thanks for taking the questions. One for Sundar.
So gesture max.
I think in terms of, first of all, we are very pleased with our TPU roadmap progress, and the value in terms of performance, and the edge it gives, and we obviously use it extensively. In terms of allocating TPUs, look, our first priority is making sure we are allocating what we need to compete at the frontier in terms of AGI development. And so that is the foundation for everything we do. But given the extraordinary demand, to balance the external demand, even for most cloud customers, we are using both TPUs and GPUs mainly for serving our models. So think Vertex AI, Gemini Enterprise, the momentum we see. So we're using it or agentic workloads, etc. So we are using it for those purposes. To the extent people want it as infrastructure, we are balancing it by increasingly looking at opportunities to put TPUs in their data centers or in other data centers, like the project we are doing with Blackstone, etc. So we're using that as an ability to balance and make sure we are allocating as much of the available compute for frontier model development, as well as serving both our consumer business and our enterprise business in terms of first-party models.
And in terms of revenue recognition and how we look at the TPU system sales, so the way to think about it is the following. When we sign the agreements that I've mentioned in the prepared remarks, they would be then reflected in the cloud backlog. Now, the vast majority of the $514 billion of cloud backlog is the GCP agreements, but the TPU system sales are reflected in that backlog. We start building inventory to be able to sell those systems. So you see that impact on the cash from operations because we built ahead, obviously, as we're building that business and ramping up. And then once we start delivering the sales, generally, that's when we start recognizing revenue. This quarter was a small amount of the total, that total agreement. Will continue to ramp up throughout 2026, but then you'll see the vast majority of the revenue from that agreements come through in 2027.
Your next question comes from Ross Sandler with Barclays. Your line is now open.
Yeah, just back to the AI model kind of war that's going on, Sundar. Just wanted to ask about like the speed of model releases and how you can potentially speed up the cadence by which Gemini is releasing models. So we all saw the third-party compute deal with SpaceX. What else are we doing to kind of speed up the pace of model releases compared to some of the other folks out there? And then you just mentioned the flash models, which have been very successful, to your point. Do you view that as like the right end of the market to be in, given how crowded the lower cost end of the model space has become? Just any thoughts on how you see all that playing out?
Thanks, Ross. Look, I mean, two things I'll say. First of all, we are, we really think about the Pareto frontier. We want to make sure for our customers, we are offering, best models at various price points, right? So, you will see us. But it's very important to us to have the best frontier models out there, as well as models which are very performant and low cost. This is why we have FlashLite, Flash, Pro, etc. And with so we are committed to being at the full Pareto frontier. On the speed of model releases, I do think you will see us continue to pick up pace. Obviously, you've seen us come with we announced 3.5 Flash at I/O. We have followed that up with 3.6 Flash, and you'll see continued iterations of that model with further progress in agentic coding, etc. We are really focused, putting a lot of effort into Gemini 4. It's a very ambitious effort. We wanted to compete at the frontier level of where the frontier will be when Gemini 4 comes out. And so we are applying a lot of our compute and effort in that direction. But with that, we are creating a baseline on top of which, you will see us rapidly iterate with subsequent model releases. And so, picking up pace and releasing models, almost at a monthly cadence is part of our roadmap as we are building Gemini 4 as well.
Your next question comes from Michael Nathanson with MoffettNathanson. Your line is now open.
Thanks. Thank you. One for Sundar and one for Anat. Sundar, just keep with the model theme of this call. Can you talk a bit about what do you think the moats are to this new model war? Right? What is your strategic advantages that fuel your business? That even if everyone gets to the same type of model capabilities, what gives you the edge to keep growing like you're doing? And then Anat, back to Eric's question, anything you tell about the margin impact on CPUs going forward, right? Is it incremental margin to the core cloud margin, or is it a lower margin coming through? Thanks.
Look, Michael, first of all, there are many layers at which we are providing solutions, right? I think part of what the value of our full stack approach is, customers are coming to us for solutions. So if you take an area like cybersecurity or data analytics, people are deploying solutions in which models are an ingredient in that solution, right? So take cyber, people are using Chronicle and Wiz, and with our upcoming CodeMender product, they're using it to detect and patch vulnerabilities and so on. Or take data analytics, people are bringing what's been in the past siloed data sources, putting it all together, and having an intelligence layer on top of it with Gemini Enterprise. And so the model is just an ingredient in those solutions. So I think it's important to remember that. Then even within where you're purely on a more model consumption area, people are, there is what looks as models are increasingly becoming end-to-end orchestrated systems, right? Workflows, agentic workflows. And to develop all this, it's your ability not just to bring the compute you need to train and serve, the data quality, the environments you have, your ability to continually improve, provide customers with that peace of mind that all the data they have, their data, their trajectories are confidential to them. None of that in any way flows back to the models. Their ability to configure and serve all this in a secure way and manage it and provision it and so on. So these are big end-to-end things. And so this is what our cloud business as a whole is focused on building it. And, and we are seeing demand across all of these components. And so obviously having our own models allows us to really optimize these solutions and bring an integrated offering. But we will also provide other models as part of these solutions. We also bring infrastructure as part of these solutions, et cetera, and take a whole full stack approach. So I think we are very, very well positioned there.
And on the TPU margins, we don't break out margins for any specific products or infrastructure component. And certainly there are benefits from designing and manufacturing our own chips. But the way to think about it is this is an expansion of our total addressable market. So it expands the opportunities by providing solutions to customers that need those systems in their data centers. But overall, if you think about the cloud margins, obviously a really fantastic expansion of margin to 35.6% this quarter, outstanding, strong operational discipline across the business and leveraging growth in the top line. And now as you think about Q3 and through the remainder of the year, and I've mentioned some of it in the prepared remarks, given the supply constraint environment we're in, we are planning to expand the use of third-party capacity in Q3 as a bridging strategy while we continue to build out internal capacity. That capacity, given the cost of that capacity, will put some pressure on operating margins for cloud. And then the last item we mentioned in the past was the integration of Wiz does create some headwind here in the near term in 2026 related to the acquisition.
Thanks, guys.
Your next question comes from Mark Shmulik with Bernstein. Your line is now open.
Yes, thanks for taking the questions. Anat, just on these third-party deals and kind of the bridge and capacity, is there a particular objective where the constraints are most severe, or is it really broad-based? And I guess, stepping back a bit and thinking about capacity allocation across the businesses, has that changed at all, or is there a way to contextualize, how you're now thinking about the trade-off between allocating compute to search versus model training versus for the GCP business? Thank you.
Mark, I can comment on it. Look, again, on allocation, I think, the baseline with which we start is what it takes to, continue AGI development at the frontier. Obviously, the priors on that are just based on where the model frontier moves, and so we start with that as a baseline. And beyond that, we want to obviously, we are prioritizing our core product areas like search, YouTube, etc., as well as cloud. And within cloud, we are prioritizing the compute to make sure we can serve our models, in the context of Vertex and Gemini Enterprise and our core solutions, be it in data analytics and cybersecurity, etc. Right? So our core serving for our core products across consumers and enterprise is where the compute is primarily going, and that's how we think about it. I think on the bridge deal, the main thing I would say is, look, there are on the margin, there are very, very large customers of ours on cloud who we are trying to support them through this extraordinary moment, and the incremental opportunities they are bringing to us, while a short-term cost over a few months may be very high, in the lifetime of the deal, as we bring more capacity on, is highly ROI positive, right? So those are factors we are taking into account. So are you willing to, take up front 6-month deal to be able to serve that customer in what is a multi-year opportunity, where the margins and the returns are very, very attractive over that multi-year horizon? So hopefully that gives some color on how we thought about those opportunities.
Your next question comes from Ron Josey with Citi. Your line is now open.
Great. Thanks for taking the question. Maybe I'll switch topics somewhat and, Philip, ask you a little bit more about monetization from a search and YouTube perspective. Just given the greater signal we have with AI searches, and then you talked about YouTube strength, talk just a little bit more on how advertisers are leveraging the greater personalization and targeting that Google has to drive this ROAS. And, a question we often get is, Google is at size and scale, we're still growing 17%. Any reasons what's driving that all-time high on searches? Thank you.
Yes, thank you so much for the question. Look, our 17% year-over-year growth rate in the Q2 search and other revenues was really driven by many parts of our business working well together and very, very deep Gemini integration. Maybe to zoom out for a second, all the major verticals contributed to the growth. Retail drove the greatest contribution. I managed this, followed by really meaningful contributions from finance, tech, media, entertainment, and so on. I think it's really important to understand that Gemini supercharges our ability, and this goes specifically to your question, to understand what people are looking for and match the right ads. So we're applying Gemini models really across our entire ads infrastructure, whether it's ads quality, advertising tools, ads and new AI experiences. And we're really deeply integrating Gemini into the customer tools to make the campaigns more efficient, which comes on top of this. And then we have our AI-powered campaigns like AI Max that help advertisers actually adapt and find the opportunities beyond keyword. Again, that's an ability for us to go deeper and target better. And AI Max continues to unlock, we mentioned this, billions of net new searches that weren't really monetizable before. And then on the YouTube side, high level, the ads growth was driven by direct response and brand advertising. I shared earlier We continue to see a lot of fermenting in the living room. We have a really exciting ads roadmap as well ahead of us on the brand side, on the direct response side. Demand gen insurance remain really interesting opportunities here. Again, this has targeting components to it, obviously. And we continue to innovate really heavily in direct response with shoppable ad formats in the living room, which will help us drive strength in retail as well.
Your next question comes from Ken Goralski with Wells Fargo. Your line is now open.
Thank you very much. Two questions, please. First, how would you assess the forecasted returns on compute capacity investments in 27 compared to prior years, 25 and 26, in light of the supply chain constraints and supply chain inflation we're seeing? I'm curious as to how you think about the return profile of 27 and kind of future investments versus past investments in capacity. And the second one, a little different topic here. When you think about Waymo, what are the key factors you would consider when evaluating a change in corporate structure for Waymo? I know you've previously been reticent to talk about this, but the business is scaling. Clearly, there's leadership there and has a lot of momentum. Under what conditions would it make?
Good afternoon, everyone, and welcome to Tesla's second quarter 2026 Q&A webcast. My name is Travis Axelrod, Head of Investor Relations, and I'm joined today by Elon Musk, Vaibhav Taneja, and a number of other executives. Our Q2 results were announced at about 3 p.m. Central Time in the update deck we published at the same link as this webcast. During this call, we will discuss our business outlook and make forward-looking statements. These comments are based on our predictions and expectations as of today. Actual events or results could differ materially due to a number of risks and uncertainties, including those mentioned in our most recent filings with the SEC. During the question and answer portion of today's call, please limit yourself to one question and one follow-up. Please use the raise hand button to join the question queue. Before we jump into Q&A, Elon has some opening remarks. Elon?
Thank you. So, yeah, it's been a great quarter. We achieved record Q2 deliveries. Model Y, I believe, is now, I think it's the best-selling car of any kind in the world, and is setting records across the board. So its popularity is increasing tremendously. And we're seeing in locations that have FSD approved, we're seeing a very high take rate of FSD. And in fact, I think for a lot of people, they're actually buying Tesla Full Self-Driving with a car attached, as opposed to a car with FSD. They're coming into our stores in the US and saying they want the Full Self-Driving, and with whatever car it comes with, essentially. So clearly, this is a significant demand driver, and as we get approval for FSD in different countries, I think we'll see a similar uptick in demand. Yeah, it's looking very good on that front. The energy business is also growing incredibly fast, and I think will be crucial for the scale-up of artificial intelligence data centers. We're investing a lot in growing the core business and really preparing for the future. So this is a massive capex year, but I'm confident that all the things that we're investing in will yield incredible returns. Really, maybe the best capex returns that we've ever seen. And just the Tesla team has performed incredibly well. The Cybercab has started production, and we also have started production and are ramping in. We will soon start production with Optimus. We have started production with the Tesla semi-truck. We'll soon start production with Megapack 3. We've started production with the lithium refinery, the cathode refinery. We're scaling up battery cell production, and we're also preparing to do a massive solar panel, like solar cells and panel production. Actually, this is going all the way from silicon refinement to producing the solar cell, and then deployment of solar, because there's going to be tremendous need for electricity in the future due to electrification of transport and AI, obviously. So we're working on what we believe is the most ambitious build-out of advanced infrastructure and manufacturing capacity ever in history. It's a big deal. So with Robotaxi, our goals are very ambitious for Robotaxi, but we do need to be cautious about causing any accidents or causing any harm to anyone. Although there are, I think, 30,000 to 40,000 automotive deaths per year in the United States alone, most of those do not generate any press on it. You never really read about almost any of those. But if we injure even one person, it will be worldwide headline news. And regulators will immediately clamp down on our activities. And we don't want to injure anyone. So we're going as fast as humanly possible in scaling Robotaxi, but while trying to ensure that we do not harm anyone at all, and ideally do not even run over a pet. So that's really the constraint. We want to go as fast as possible with Robotaxi without harm to anyone. And we're providing live updates before Robotaxi launched, as we open up in a city, we immediately post that on X. So if you just follow the Tesla account on X, we'll keep you informed as we scale to new cities. We've opened up in a number of cities in Florida and in Texas, and obviously in the Bay Area. So we'll continue to scale, I think, very very rapidly with it looks like more than 10% a week in terms of miles driven. So it's a very high compound growth rate.
Oh my God, bro.
So let's see, Optimus. As you've heard me say before, I think Optimus will be the biggest product ever, but it is a very complex problem to solve. It's one of the hardest things to solve, to make an autonomous humanoid robot that can do tasks that if you simply ask it to do something or show it a video, it can do the task without any programming. Like no one's ever achieved this, and there are many challenges in the electromechanical design of the robot to achieve sufficient dexterity and also be very reliable and have long wear and tear. Like meaning it needs to be out in the field and not break down. Otherwise, you've got sort of a 70-kilogram robot that just flopped over, and you've got to carry it out like a body. It doesn't have wheels. So and we don't want Optimus to go haywire. It's a lot of work to scale to get the design right and to scale production. And I really want to emphasize here that the production scaling challenge is very substantial. This is going to be the hardest product to scale manufacturing that we've ever made at Tesla, because everything on the robot is new. And the difficulty of scaling the production ramp is proportionate to the newness of the parts in the robot. And at least with electric cars, the non-electric powertrain portions of the cars had an existing supply chain. So you could go to existing suppliers for wheels and side mirrors and windshield glass and that kind of thing, body panels. And with Optimus, there is no supply chain. So we've had to build up a supply chain in its entirety, or in-house the production. And we actually in-house a tremendous amount. The Optimus production line that we're building out in Fremont, in place of what used to be the Model SX production, it looks incredible. I mean, it's quite stunning to see. So I just want to make sure to calibrate people correctly. Optimus will follow the sort of normal S-curve of manufacturing, of a manufacturing ramp, but the initial portion of the X-curve will be quite flat and long because of the newness of the parts in the robot. You've probably seen lots of impressive demonstrations of robots on the internet, but those demonstrations you're seeing are pre-programmed or remote controlled. So there is no humanoid robot that is actually able to do generalized tasks. Optimus will be the first one that is capable of doing that, where it's not just a demo; it's genuinely useful in day-to-day life. So, and Optimus is designed to have full human dexterity, so a hand that has the same level of dexterity, if not higher, than a human hand. And the human hand is an incredible thing. The more you study the human hand, the more amazing you realize how amazing hands are. It's more than just opposable thumbs. I mean, the nuances of how human hands work are amazing. As the closer you look, the more amazed you are. And Optimus will have that capability. It'll have human and then superhuman dexterity. So it's really going to be quite something. Let's see, Terafab. The Terafab, we expect to announce the location soon, and provide more details about our plans in that regard, which we'll leave that to the product, sort of the launch announcement, rather than try to squeeze it into an earnings call, because I think this is a very big announcement, and it deserves to have its own sort of stay in the spotlight and not be sort of squeezed into an earnings call. But I do think Parafab is going to be an amazing initiative and a necessary one, and one without which we will be constrained in our ability to scale Optimus production, because we simply won't have enough AI chips. So it's crucial to solve that, and we'll have to solve memory, logic, and packaging in order to scale Optimus. But anyway, like I said, we'll leave that to its own announcement. We've placed equipment orders for our development fab in Austin, and that development fab, I think, is pretty cool because it's intended to have lithography mask production, and then logic, memory, and packaging, and chip testing all under one roof. So you can have a very fast iterative cycle, and try out new chip designs very quickly and see if they work. I don't think such a building exists anywhere on Earth. So this is really going to be super helpful as we try some exciting, adventurous, high-risk, high-payoff bets on AI chips. So it's focused, like I said, on primarily on Optimus. Like, how do we make Optimus as useful as possible? Then we have digital Optimus, which is basically just driving a computer screen. I guess you could call it computer use or something like that. But driving a computer screen in the same way that you drive a car. So for the car, it's sort of pixels in or photons in and controls out. The same thing is true for Optimus, digital Optimus. It's photons in, controls out. So we feel confident we can adapt the same Tesla AI technology that we developed for self-driving cars to have a self-driving computer screen, or self-driving computer, essentially. The self-driving computer, where the Tesla, the very, very low-cost Tesla AI4 computer can handle all of the short-term tasks. They're doing real-time video control of the screen of the computer. So it's not like screenshots. Everything is real-time video at high frame rate. And the digital Optimus will be important, obviously, for physical Optimus, because physical Optimus needs to be able to operate computers. It can't come up to a touchscreen and not know what to do. It's got to have a generalized touchscreen and computer use capability. So that's looking promising. And this is in partnership with SpaceX's Grok, so the big model that is kind of like the manager of digital Optimus, and kind of tells digital Optimus what to do, provides it with a series of tasks, and then digital Optimus goes and does those tasks. We're also building out a megapod design that has Tesla AI4 computers with x86. So carrying an x86 computer with the Tesla AI4 computer in a box. And it's got this digital Optimus in a box. And in a megapod, kind of like the Megapack packaging, and so where we put just a large number of AI4 plus x86 combos in a giant box, essentially. And these boxes can be placed anywhere in the country or outside the country. And this allows us to scale AI compute using disaggregated electricity production. So because there's lots of places all around the world, including at our superchargers. I think we've got something like 7 gigawatts of power at our superchargers and growing. and we can place megapods at many of these superchargers and have distributed power for AI. So I think that could be quite a big deal. So in conclusion, we're super excited about our autonomy and robotics roadmap. There's so much awesome stuff coming. It's like I said, hard to squeeze into an earnings call. But we'll have a lot of product announcements. And this is going to be a great year for Tesla. I think one of our best years ever. And then I think next year will be even better. So in conclusion, I want to thank the Tesla team for their excellent execution and all of our supporters for joining us in this journey. Thank you.
Great. Thanks so much, Elon. And now, Vaibhav has some opening remarks.
Thanks, Travis. So Q2 continued the trend that we saw at the end of Q1, a resurgence in demand for vehicles across the globe. We achieved record Q2 deliveries globally with sequential growth across the Americas, APAC, and EMEA of 60%, 27%, and 12% respectively. Additionally, Model Y set records in several key markets, including the Netherlands, Australia, and New Zealand. The efforts of the Tesla team to create compelling products at a reasonable price with the capability of autonomous driving are coming to fruition. We exited Q2 with our largest order backlog since 2023. We are therefore focused on increasing production at all our factories to meet this growing demand. Production growth will be limited by our supply chain. This includes not just batteries, but also electronic components. We've been here before, and like always, our Tesla team is working actively to unblock the obstacles ahead by securing strategic deals with suppliers. Like Elon mentioned, one of the key factors for vehicle demand has been FSD. Our sales data suggests one of the main reasons customers are coming and looking at the car is because of FSD. In Q2, we had in North America, about 55% of our deliveries had FSD subscription at the time of delivery enabled. Overall, FSD attach rates continue to improve, reaching nearly 1.5 million paid customers globally, of which 55% is upfront purchases, and the remaining 45% is subscriptions. We expect that the bulk of the growth in FSD monetization will come from subscription, as we've removed the purchase option in most markets. Automotive margins, excluding regulatory credits, declined sequentially from 19.2% to 16.3%. As a reminder, we had highlighted in Q1 that we had a $230 million benefit from warranty true-downs and some tariff relief, which did not repeat in Q2. Controlling for the impact of those benefits from the prior quarter, our automotive gross margins, excluding credits, would have been approximately flat. This demonstrates the effective pricing and cost management done by the Tesla team as we continue to drive demand. Commodity price increases and interest rate changes all continue to add to our costs. Note that interest rate subvention costs are recognized upfront as revenue offset. So as interest rates have risen this year, the cost of subvention has risen along with them, which had a negative impact on automotive margins. As we have previously noted, energy business is inherently lumpy. Deployments are tied to customer timelines and largely out of our control. In Q2, we deployed 13.5 gigawatt-hour of energy storage, a 53% sequential increase, and the second largest quarter for energy business. Despite this growth, energy gross margins declined from 39.5% to 20.4%. This margin decline was a result of several dynamics. First, there was a warranty true-up in the quarter of about $240 million related to certain vendor cell issues for our legacy deployments. Also, the tariff benefits we recognized in Q1 of more than $200 million did not repeat. And lastly, we had previously guided that ASPs for industrial storage is coming down amidst growing competition. Long term, we believe the energy business should normalize at a gross margin rate in the mid to low 20% range. Our order backlog of this business is robust, and we are doing our best to build based on both existing demand and future demand we expect from data center growth and overall electrification of the economy. Service and other margins improved sequentially from 9.2% to 14.1%, an all-time high. This was mainly driven by an uptick in volume and better cost management of our vehicle fleet that supports businesses such as used car, supercharging, service centers, and insurance. While marginal today, also included in this business are deliberate investments we are making in infrastructure that will help scale robotaxi in the future. We continue to grow the Tesla robotaxi fleet and have expanded to a total of 7 markets in the US. We expect the ramp of the fleet to accelerate throughout the year, along with expansion into new US markets. As previously guided, operating expenses increased sequentially. The increase came primarily from significant research and development related activities, including pre-production ramp costs for new products like the semi-truck, Optimus, Cybercab, and other AI initiatives, as well as depreciation for an additional compute that we brought online. Additionally, we had charges related to litigation expenses in the quarter. Note that we are in a big investment cycle and expect our operating expenses, largely driven by R&D, to continue to grow in 2026 and beyond. Net income was positively impacted by a mark-to-market gain of $1 billion on our SpaceX holdings, which was offset by losses on FX of approximately $300 million and on Bitcoin of about $100 million. As previously guided, our free cash flow ended up being negative for the quarter. Most of the reason for it going negative is because CapEx more than doubled sequentially, and we expect it to increase further in the second half of 2026. We continue to expect that CapEx for this year will be more than $25 billion. CapEx will grow for the next 2 or 3 years as we expand our robotaxi fleet, expand our production capacity for Optimus, make investments for semiconductor fab, install solar manufacturing capacity, and AI compute infrastructure, in addition to all the other expansions we'll do for other manufacturing for automotive. In addition to using our cash for such investments, we are being opportunistic in securing certain debt facilities that will give us the capacity to borrow up to $30 billion to help accelerate such investments. We believe this is the right strategy to position the company for the next era, and we'll always make such investments in a very capital-efficient manner. The path to amazing abundance is ever challenging and requires making bold bets. Our progress will be non-linear. The future is going to be great, and we are ready to rise to the occasion. I would like to end by thanking the Tesla team, our customers, investors, and suppliers for their confidence in us on this journey.
Thanks so much, Vaibhav. As everyone on the call may have noticed, we've covered several of the Say.com questions already in opening remarks, including Optimus production, Terafab, and Digital Optimus. Ashok is joining us today, our VP of AI, and he's going to cover questions related to robotaxi. Ashok?
Thank you, Travis. Many of the questions on Say.com relate to robotaxi deployment and scaling, so we thought we'd provide a comprehensive view of where we are now and where we are going in the future. First of all, I'd like to state that the robotaxi program has been operating extremely well. Especially in terms of safety, the program has had an impeccable safety record. We have driven more than 380,000 miles of unsupervised robotaxi, now across 6 cities in 2 different states. We have had 0 notable incidents. Any reports have been of other actors impacting us when we were stationary. Again, I like to emphasize how safe the operation has been so far. 0 notable incidents over 380,000 miles. Historically, the so-called experts have always claimed that you need LiDARs, radars, HD maps, and the entire kitchen sink to drive safely. Here we show that such is not true. You can have safe, comfortable, and affordable autonomy with just cameras. This record should be a huge validation of Tesla's entire AI approach. Second, I'd like to discuss scaling. We started the robotaxi program roughly a year ago in Austin. We had safety monitors in the passenger seats of the cars back then. Around the end of last year, we had the first fully unsupervised robotaxis in Austin. Since the beginning of this year, we have grown at double-digit growth rates to the number of unsupervised miles that the fleet drives every week. I repeat, we have grown at such a high compounding rate on a week-over-week basis over the last several months. Not only that, we expect to continue growing at such a large rate through the rest of this year. The other thing to note is that for expanding to new cities, it has been relatively less effort on our front. We expect that the time to launch to a new city will continue to trend towards zero, towards an end where we operate in entire states as a whole instead of going by city by city. Such growth was only possible because we have a world-class engineering team at the Frontier AI development here at Tesla. The currently operating robotaxi fleet is already running early versions of the V15 FSD software that we had referred to in the past. For V15, we had planned roughly about 7 major improvement tracks, and they're all happening in parallel. The early V15 builds that are running on robotaxi have already 40% of those tracks merged together, and that's what's running in the fleet right now. As we continue to complete our work on V15, we will see that the car is going to be ridiculously safe and capable. We're already seeing internal signs that all of these bets that we have made for technology improvements are all starting to work, and we expect that the payoff will be huge, and that's what is going to help us sustain the same growth rate through the rest of this year and so on. Finally, regarding the Cybercab, first of all, it's a phenomenal product. Anyone who rides in it instantly falls in love with the experience. We have aligned our manufacturing targets to roughly match the projected growth rate of the unsupervised miles. The same V15 models that power the Model Y and other platforms will also work on Cybercabs. In conclusion, robotaxi growth so far has been literally exponential while keeping an impeccable safety record. Our technology bets are paying off, helping us sustain the exponential growth for the foreseeable future. And the Cybercab is going to be awesome.
That's great. Thanks so much, Ashok. And there was one remaining question on data collection for Optimus training. Would you mind covering that as well?
Regarding Optimus, especially Gen 3, Optimus has been designed to not just match the appearance of human beings, but also the functionality and dexterity of humans. One of the main reasons for this approach is that having the human form factor and function allows us to learn from humans on how to perform a wide variety of tasks. This opens up the entire world to provide data for training Optimus. Just like FSD, we have access to a broad fleet of humans giving us data from all of the workers at our factory. Optimus can learn quite a bit from observing them perform their tasks at the factories. We also have a dedicated data collection team who can provide a relatively small amount but of very high quality demonstrations to do the post-training of these models. This is all on top of any training we can do off of the entire internet of data that shows demonstrations of people doing various tasks, both in industrial settings and home settings. The second flywheel is when we have a large number of Optimus robots practicing their tasks in what we call the Optimus Academy. The data from the bots experiencing the tasks themselves will be invaluable and help us close any minor form factor gaps that may exist between the bot and the humans. This is also when the reinforcement learning loop kicks in, where the bot initially attempts some task, fails sometimes, learns from both the successes and failures of those tasks, and eventually learns to master those tasks at perhaps a superhuman level. Our AI strategy for Optimus is aligned with the same. It's the same end-to-end strategy that drives FSD, pixels in, controls out. And just like FSD, we expect it to work broadly. In FSD, you can get in the car, type in an address, and then hit start, and it's like handles all of driving from park to park. And the same thing is going to be true for Optimus as well. You're going to just ask it to do anything, and then it just perform the entire task on its own without you having to do anything along the way. And it's the same team that produced FSD, the V12, 13, 14, and now V15 software that now works on Optimus as well. Hence, I'm very confident that Optimus will be an extremely capable robot.
Great. Thank you so much, Ashok. So that covers the say.com questions. Now we will move over to analyst questions. The first question comes from Tom from RBC. Tom, please feel free to unmute yourself when you're ready. Tom, you're still on mute, so please unmute yourself and go ahead and ask your question. All right, we're not getting any audio from Tom at the moment, so we will try to move on to Andrew, and we'll add Tom back to the queue to come in next. So Andrew, as soon as you can, please unmute yourself and ask your question.
Hey, can you hear me?
Yes, we can.
Awesome. Thanks so much for taking the question. So maybe just to start out on Optimus, Elon, you mentioned that there's really no supply chain today for Optimus, so you've had to mostly insource a lot of that yourself. I'm just curious, as you've gone through this exercise, are you seeing any suppliers willing to invest alongside you to set up domestic manufacturing to potentially help you scale more quickly in the U.S.? Asking that in the context of obviously, you want to control your own destiny to some extent and ramp as quickly as possible, but from an investment cycle standpoint, potentially more capital efficient to have some partners, help you along the way. So I'm just curious how you're thinking about that and some of the dialogue you've had with potentially some external suppliers.
Elon, you may be on mute right now. We can't hear you.
So yeah, our supplies have been great, and they have made and are making tremendous investments in support of Optimus and robotaxi and whatnot. Samsung and TSMC in particular are building fabs. TSMC in Arizona and Samsung in Texas, and putting in tens of billions of dollars to build AI compute for Optimus and robotaxi. Panasonic has also invested many billions in increasing battery cell production. I'm a little under the weather here. I'm a bit ill, so if I sound a little off, I'm kind of struggling with I'm a little bit ill today. So yeah, but our partners have been great, and I'd like to thank them for their support and their investment and their hard work.
Great, thanks for that. And maybe just as a
sorry, Andrew, we're going to have Karn hop in here for additional color briefly.
Yeah, just to add to Elon's point, that the Samsung fab that's going to be pretty significantly dedicated to future projects. That's a massive investment, multi-billion-dollar. We're seeing the same level of investment going into memory, and also new specific parts like metal injection molded parts, flexible printed circuits, and all sorts of nonlinear technologies that are more based for the robot as opposed to the traditional vehicle supply chain we've had. And in certain cases where we don't find a great partner, we've never hesitated from insourcing it, and we have a very capable manufacturing engineering team and a design team that helps us scale those things.
Yeah, and actually, I'd also like to thank Micron for giving us memory allocation. They're going to make some very tough decisions on memory allocation, and we really appreciate Micron making room for Tesla in the years to come and giving us actually a very significant allocation on reasonable terms, given the pretty insane pricing of memory these days.
Great, really appreciate that color. And maybe just my follow-up on robotaxis. You guys gave a lot of great information in your prepared remarks, but there seems to be some evolving regulations at the state level, potentially around sensor requirements. So I'm just curious, as you think about your own rollout, what do you want to see, or what do you need to see from regulators to make sure that, obviously some regulation might be good, but you don't want it to be overregulated. So what are you expecting to see? What do you want to see to make sure that this is, done in a proper way?
And we've got Lars on the line. Lars, if you wouldn't mind covering this one, if you can.
Yeah, sure, Travis. I think, we talk about regulation, particularly in the U.S., we've made a lot of headway. Just good initiatives from the federal government in terms of the FMVSS rules, moving towards, acceptance and adoption of purely built AVs, and I really appreciate the support from NHTSA on that. When it comes to like a state-to-state level, obviously the stuff in New Jersey, is a little bit disheartening. I think ultimately, as Ashok said in his opening remarks, we really focus on the performance of the vehicle, and ultimately that's what's going to drive regulators and the public to adopt it. I think the best regulations are those that provide companies and innovators with a goal or a task and allow us to figure out the solution. And when we see regulations that provide a solution before identifying the problem, we really don't, appreciate those. But as Tesla always has and will continue to do, we'll let our performance speak for itself. And I think Ashok played that out really clearly, and that'll be the foundation of our expansion moving forward.
Great. Thanks for the questions.
Thanks so much. We're going to try Tom again. From RBC. Tom, can you unmute and try to speak, please? Unfortunately, Tom, we see you unmuted, but we're not hearing you, so we're going to have to send you back into the queue. Next is Alex from Bank of America. Alex, as soon as you can, please unmute yourself.
Hey, thanks for the questions here. Just a few follow-ups on Robotaxi, actually. I guess, what milestones should investors be watching from here that would cause you to accelerate your fleet scaling or market deployments? Is it the further safety validation, like a miles driven per incident or something else? And then would you ever consider third-party distribution partnerships, such as with rideshare providers, to increase utilization, or is the plan for now to keep Robotaxi fully vertically integrated? Thanks.
Yeah, we expect to be vertically integrated with Robotaxi as we are in the rest of our business. So I don't think we're going to have any demand challenges with Robotaxi. So this is, but the economics will be so compelling that I think we will really have a lot more desire to use the service than I think demand will outstrip our ability to service the demand, and so obviously you can just go vertical in that situation. So it's really just about going through and what we call the march of nines of reliability, where you need like how many nines of reliability do you need to scale? Ideally, you want 99.99999% reliable, and so it's just the march of nines of reliability is I think the only thing really constraining our growth in Robotaxi.
Great. Thanks, Elon. The next question is going to come from Colin at Wells Fargo. Colin, please unmute yourself when you're ready.
Oh, great. Thanks for taking my questions. There's been a lot of chatter about SpaceX and Tesla combining in some way. A lot of collaboration already today. Elon, do you see synergies eventually from combining the companies? And does that make sense from your perspective over time?
Well, as you can tell from all the many collaborations on so many fronts with SpaceX, and there's more and more overlap, especially with TerraPower. That's really going to be a gigantic project. But obviously we can't talk about combining companies and that kind of thing on an earnings call. It's got to be done with the appropriate process. And with that, I'll turn it over to Brandon, our General Counsel.
Yeah, no, thanks, Elon. And that's exactly right. We continue to benefit from
SpaceX, and they've been a great partner, and we have numerous beneficial transactions with them. And earlier this year, we deepened our relationship through an investment and a framework agreement. And this will allow us to continue to work with them on projects that Elon mentioned, like TerraFab and Digital Optics.
Yeah, and there's many other things too. Obviously, you've got Grok in the car, and Grok helping, drive Digital Optimus. You've also got Starlink being integrated into the Cybercab, and Starlink will be integrated into all of our vehicles, at least for markets that Starlink is active. Because for a robotaxi situation, you need to have coverage everywhere. And there are many places, even in Silicon Valley, where the cellular coverage is terrible or sometimes non-existent, which is surprising for Silicon Valley. But I know when I drive to work, those first 10, 15 minutes, I can't actually do any calls because the cellular connectivity is so bad. So we can't have robotaxis getting stuck in these like Bermuda triangles of lack of cellular connectivity. So Starlink, with its ability to do connectivity anywhere, is actually quite important. So we don't have robotaxis missing in action. And then obviously if people are sitting in the car, they're going to want to do high productivity stuff or entertainment. And with Starlink, you can watch 4K live sports in the car, and with very low cost per gigabyte of data. That's really not feasible via the cellular system. And there's many other situations.
Yeah, I mean, I would say think of it like Ashok was mentioning about Cybercab, right? That the experience is great. In a world when you don't have to focus on driving, you have all the time in the car to do, whether it's a conference call, watch a movie or anything. That's why if you look at the Cybercab design, it has a big screen. And we've started doing Cybercab rides in our factory in Austin. And when you go through that experience, soon customers would be able to do it in not too distant future, and then you'll understand why that connectivity becomes so important.
Great. And then Colin, do you have a follow-up?
Yeah, just if I would follow up on Robotaxi, if I look at the launches, you've been adding cities, but the number of units is still, looks like based on media reports, sort of in the dozens as opposed to hundreds. Why not just sort of scale up Austin or one or two cities before adding cities? And sort of what do you need to sort of get that higher volume numbers in a major city? What sort of is the roadblock to sort of adding more vehicles on the ground?
Yeah, the reason we have been expanding across different cities instead of just doubling down on a single city is that we want to make sure that our stack is a very general one. It is a general one. We just want to both prove to ourselves and to other folks that it is working across a lot of different cities without too much effort per city. And that's what we see internally. And then, as Elon mentioned earlier, the growth rate has been literally exponential. Just it's in the early part of the exponential. That's why it's hard for others to comprehend. In terms of like miles versus the vehicles, since these vehicles operating the robotaxi fleet drive basically continuously, as opposed to human drivers who use vehicles for maybe a couple hours a day or something like that, these vehicles are in mostly continuous operation, which means that even for a few vehicles, you can get a lot of miles out of them. And that's why we are tracking the amount of unsupervised miles or just the number of vehicles or something like that. And we want to be operating in a very efficient fleet. So all of the work that goes into the efficiency makes it even more so that we get a lot of miles per vehicle available in the fleet.
Yeah, and just to add further to this, think of it, we're trying to scale this, and we're trying to make sure that there are different kinks which would be there. And there are things not just on the software front, on the operation front, which we're also trying to tackle. So that's why we're trying to have a broader footprint to try and make sure before we go really high in terms of deployment, that we are able to sort these things out in a smaller fleet in a controlled manner.
Yeah, one of the things for Cybercab should be noted is because it is a new vehicle chassis, we need to accumulate driving data that is specific to the Cybercab before we can put a lot of them on the road. So unlike say Model 3, Model Y, and our other vehicles, where we've got a lot of vehicles on the road, millions of vehicles on the road, we don't have that for Cybercab, so we actually have to accumulate miles with Cybercabs that are retrofitted with steering wheels and brakes, acceleration, braking pedals, that kind of thing, to calibrate to the Cybercab chassis. So you'll see as we are confident about that, the number of Cybercabs in cities will increase dramatically.
Great. Our next question is going to come. Oh, yeah, go ahead, Lars.
If I can just add like one thought here. The other reason I just want to like point out is, TCO, transportation regulatory situations are different city by city, state by state. There's not a federal, framework to do that. And so like the reason we're expanding city by city is to make sure that we're meeting all of those one at a time, and we're satisfying, all of the requests of each individual city and in every way we can. And so we have to expand, to each city to meet those requirements, and we'll continue to do so. And until all of what Ashok and Vaibhav and Ashok said, we'll follow with the scaling.
Thanks, Lars. The next question is coming from Walt from Lightshed. Walt, please unmute yourself.
Thanks. Just a quick follow-up for that Lars comment. I mean, the NHTSA administrator, Jonathan Morrison, was just on CNBC. He already, was trying to get rid of the pedal and said, I forget his exact term, but it seemed like he wanted to get rid of the steering wheel. It seemed like that would be a gating factor. But is there other things that you need at the federal level to really kind of unlock your ability to ramp Cybercab?
The short answer is no. I think we have a great relationship with NHTSA and Director Administrator Morrison especially. I think they're just following through with what the public wants and the world knows is coming, and they're trying to stay ahead of it and make sure that they're doing the right things in place. So we've been open and honest with them for the last couple of years about what our plans were and what we're doing, and I don't want to say we're in lockstep, but I feel like we have a partner there, and we're working together on it.
Got it. And then just, Elon, there's kind of a roadmap question, I guess. Starlink obviously is integrated in Cybercab, and you guys just talked about the connectivity for watching movies, but what about the flip side of that? Can the Cybercabs become remote hotspots for Starlink Mobile? And then similarly, roadmap question on the Semi, when do you anticipate looking at autonomy for the Semi? Because that seems like a pretty sizable market as well in terms of autonomous trucking and the need for it, given what's going on in our country right now.
Yeah, absolutely. As you allude to, there is a really serious shortage of truckers. So there just aren't enough people who want to drive trucks, which are crucial for transport throughout America. So an autonomous Semi is actually going to be very important to address the shortage of truck drivers. And obviously will be great for improving safety and making it easier on truck drivers to have a self-driving Semi is going to dramatically improve safety and comfort for truck drivers that use this as a Semi. Since the units, the total number of units of the Tesla Semi is still low and will continue to be a very small percentage even by the end of this year of our total vehicle fleet, it makes sense for us to focus our self-driving efforts on our high volume vehicles, so Model 3 and Y, and solving self-driving and really getting to the point where it's generalized, unsupervised self-driving for those vehicles and Cybercab. So we expect to get self-driving working on the Tesla Semi probably around the end of this year or early next year. But I just don't want it to be a distraction on the on the march of millions of self-driving of safety for self-driving on freeway and cybercab. That's so that it's taking a bit of a backseat for the next 6 months or so for autonomous semi. But it will be, it will definitely be a bit working next year and in time for the scale up to high production of Tesla Semi. For communications, yeah, I think there's an interesting angle there where you could use the Starlink terminals that are in the Tesla cars as like sort of cell towers, I suppose, or connectivity towers, basically for providing relays on the ground to cell phones and to anyone who would like Wi-Fi, basically. But yeah, I mean, this is a different subject, but obviously one could do that with the stationary Starlink terminals too.
All right. Our next question is going to come from Will at Truist. Will, please unmute yourself.
Great. Thanks so much for taking my question. Elon, you teased us a little bit about sort of the supply chain relative to Optimus, highlighting how difficult it's going to be, but we'd be really interested to understand what your propensity is to manufacture semis for this yourself. When we think about microprocessors, microcontrollers, actuators, and other semiconductors that are going to be used, it occurs to me that you have many that are commercially available. You have an option to design some but have them made at third-party fabs. You also have the option potentially to design and make them yourself. What should we think about your propensity to source these components in these different manners?
You're talking about making like microcontrollers and small, like the various computers that are in the car that operate, like the steering system and the braking system.
No, I'm talking about for Optimus, not for.
Yeah. Optimus has a lot of really specialized power electronics and circuit boards. It's all Tesla design stuff, but it is fabricated by suppliers. For Optimus 4, which will be built in Austin, that will be a much more vertically integrated supply system for Optimus 4, and that would we'd aim to have an order of magnitude more production of Optimus 4 than Optimus 3. So it's sort of aspirationally 10 million units a year versus 1 million units a year of Optimus 3. But with all the caveats there, which is insanely difficult to scale production. Yeah, Optimus 4 will be much more vertically integrated. So probably doing a lot of the sort of PCB work in-house for that.
As a follow-up, well, first maybe you could talk about the timing as to when Optimus 4 should be, let's say, start production. But the actual follow-up I wanted to ask was the plan to upgrade hardware 3 to hardware 4 in order to be able to process, I suppose it's version 15 of the and future versions of FSD. Is that still the plan to do hardware upgrades on the cars?
I think it's going to make sense to upgrade all cars that are have less than hardware for almost all any cars that have cameras, basically, because otherwise it would be probably too many modifications. But anything that's got sort of that's set up for cameras, it'll be financially sensible at some point to upgrade them. But I think we'd want to upgrade them to the next generation of like next generation AI board. So it would be either like we have an upgraded AI4 chip that's sort of a medium, sort of moderate improvement over AI4, probably reaches production around the middle of next year. and then there's also AI5, which hopefully is in volume production around the middle of next year. AI5 will initially go into Optimus. And actually making very good progress. So the Tesla chip team is really doing great work and making incredibly fast progress on AI5. And I'm very excited about the design of the Tesla AI6 chip. I think it's going to be the best edge computing chip in the world. And if somebody's got a better one, I'd like to meet that person and shake their hand, because the AI6 chip is just so good. So I think we got things going really well on the chip front. Yeah, and again, I'd like to thank TSMC and Samsung and Micron for the support.
Great. We are coming up on the hour, but we're going to try to squeeze Dan in. So from Barclays, Dan, please unmute yourself.
Great. Thank you. Appreciate it. I'd like to ask about the pace and path of CapEx. Elon, in the past, you've said that you'll spend as much as you can, but really efficiency seems like it's the gating factor. So to what extent right now in this CapEx cycle is your pace of CapEx effectively capped simply because spending any more would be done in an inefficient manner? And to what extent is the pace of CapEx really the primary determinant right now in unlocking the different supply constraints that you have?
Yeah, it's a good question. I've actually, what I've asked the Tesla team to do is like really we should be spending on CapEx as fast as we can spend, as fast as we can without it being too wasteful. So we're not trying to aim for like some extremely high efficiency capital spend, because that would slow things down. So it's a balance between like how much sort of capital efficiency versus time. So if we can be, it's okay to be a little less capital efficient if we get things done sooner, because that's actually going to be the higher NPV outcome for the company. So overall, I'm pretty happy with how things are going. I mean, we're doing an incredible amount of construction and production growth in so many different arenas simultaneously. I don't think there's ever been a company that's done this at the scale, maybe proportionately back when Henry Ford did the Model T or something like that, but or World War II when companies were making, had to sort of scale up weapons production. But I think probably this is the fastest industrial scale up since World War II in America.
Yeah, and I will just add a little bit on that. Basically, if you look at it, all our spend on CapEx is trying to do productive assets, right? We're basically scaling factories, whether it's Optimus, whether it's Cybercab, whether it's LFP factory, which went into operation earlier this year, or the semi factory, or even putting in a semiconductor fab in there, as well as, we are trying to get a lot of solar manufacturing in the US. In fact,
yeah, very important. This is underrated, by the way. Please go ahead.
Yeah, basically, the amount of solar manufacturing which happens in the US, we're just going to multiply it with an order of magnitude. And none of these things are easy, right? Because what you have to do is, in order to build a factory, you have to start from ground zero. So just so you know, again, I don't think we have shared this. We end up being the general contractor for almost all our construction facilities because we are doing that much construction. And so going back to what Elon was saying, we're going at a very rapid scale. And yes, this means that we are doing a lot of things all at the same time. And that's why, we just have to go as fast as we can, humanly make things work in the real world.
Yeah, but our CapEx efficiency, I think, is off scale good.
Alrighty. And then Dan, did you have a follow-up that we can wrap up with?
Yeah, maybe just a quick question on energy storage, which I think is a key topic here. Maybe you can just address, to what extent is energy storage going to be supply constrained for the foreseeable future, and then just to what extent are the deployments right now the typical peak shaving that you'd see at utilities versus you've talked about in some of your materials, for battery storage, addressing the quality of power issue for data centers, given the sharp fluctuations in power use, where you have an advantage given software or power electronics. So just what is that demand curve right now between data centers versus just broader peak shaving for utilities?
Well, it's still mostly, it's not just peak shaving, but it's also grid balancing. So it's not just like the packs are on briefly, but for balancing power from wind generation and solar generation, batteries are awesome. I mean, the solar battery combination will be how the vast majority of energy in the world is produced in the future. That's already, of course, how all of the Starlink satellites are powered, is with solar panels and batteries. So, and you can just think of Earth like a giant satellite. There's far more power available from the sun than anything else by far. And we think power constraints are going to be, there already are a major issue for AI, just turning on the AI computers. The AI compute demand is so high that people are having, even the so-called, the hyperscalers are having trouble turning on their AI compute and finding the power and then smoothing the power with, especially for the training runs where the power cycles dramatically in a very short period of time. You can have, during a training run, the power consumption can drop by 70% for 100 milliseconds. And you really need fast-acting advanced power electronics to be able to smooth out these massive changes in power, especially during their training runs. So that's why SpaceX has bought so many megapacks for the data centers. It's actually mostly for smoothing out the power for the training runs. But it will also be useful for being able to tap more power from the grid by if you tell utilities that they can that they will not need to supply power during the worst hours of the worst days of the year because the batteries can handle it, then that makes it much easier for them to give you power. In fact, I mean, probably the best way to scale total energy production in the United States is simply using batteries, because there's, I think, around 1.2 or 1.3 terawatts of power production in the US, but the average power usage is only half a terawatt. So you've got 2.5 times as much power generation as the average usage. That means you could potentially double the energy output of the United States just with batteries. So we see demand for Megapack being very, very high in the future.
Alrighty. That is all the time we have for today for Q&A. We appreciate everyone's questions, and we look forward to talking to you next quarter. Thank you very much.
All right. Thanks, everyone.